Welcome, class. So today we're going to do a deep dive analysis into a really critical and, frankly, often overlooked final step in the accounting cycle, the post-closing trial balance. Now, for those of you who are going to go on to be managers, analysts, or business leaders, a really thorough understanding of this final checkpoint isn't just a good idea. It is absolutely fundamental. The integrity of the financial data you'll be using to make huge strategic decisions, well, it all hinges on the accuracy of this one process.
So let's start our journey here with a core question. I want you to imagine a company, let's say a huge retailer like Target or Walmart, that's just wrapped up its fiscal year. I mean, think about it. Over that year, they've processed millions, maybe hundreds of millions of transactions, billions in revenue, a massive list of expenses, salaries, inventory, marketing, you name it. So how does their accounting department prove definitively that the financial story of that year is complete, accurate, and ready to be put to bed? How do they make sure that the next fiscal year can start with a perfectly clean slate? Now, this is not just some academic question, students. This process is the very foundation of reliable year-over-year financial analysis, and that's crucial for everything from getting a bank loan to making massive investment decisions.
Well, the answer to our big question lies in this essential process we call closing the books. Now, that phrase might sound a little dramatic, a little final, but it's really all about a methodical transition. It's the systematic process of closing one chapter of a company's financial story so that the next one can begin with total accuracy. To really get the significance of this, we first have to understand the two fundamental types of accounts that exist in our financial story. Think of them as the main characters in our story, each with a very, very different role to play. All right, now let's dissect the two fundamental categories of accounts that are just absolutely central to this whole closing process. You're going to want to pay close attention here, because understanding this distinction, it's non-negotiable for accurate financial reporting. This is a concept that will be on your exams, for sure, but more importantly, it's going to be a cornerstone of your future careers in business. Mastering this difference is really what separates a simple bookkeeper from a true financial analyst. This slide gives us a fantastic visual metaphor for this idea. Over on the left, we've got our temporary accounts. I want you to think of these like the scoreboard for a single football game. Your revenues, ticket sales, merchandise, TV deals, and your expenses, player salaries, stadium upkeep, travel costs. They tell you how you performed during that one game. In our world, that's one accounting period. And what happens when the game is over? You reset the scoreboard to 0 for the next game, right? That's what we do with these accounts. They also include things like dividends paid to shareholders. They're closed out because they measure performance over a period of time. Now, on the right, we have the permanent accounts. These tell the ongoing, cumulative story of the football team. They are the assets, like the stadium itself or the cash in the bank, the liabilities, like any loans they took out for new equipment, and the owner's equity, which is their stake in the team. These balances don't get reset, they carry forward, reflecting the team's cumulative financial position. They give us a snapshot of the company's financial health at a single point in time. Okay, so now that we have a really firm grasp on the difference between temporary and permanent accounts, the story of the period versus the ongoing story of the business, we can finally introduce the specific tool that accountants use to verify that this whole closing process has been done flawlessly. This is where the post-closing trial balance steps onto the stage.
And here's the formal definition. A post-closing trial balance is pretty much exactly what its name says it is. It's a trial balance that we prepare after all those temporary accounts have been closed. Its only job is to list the permanent or balance sheet accounts to provide one final definitive mathematical check. As you know from the bedrock principles of accounting, in double-entry bookkeeping, for every debit, there must be an equal and opposite credit. This report confirms that after all the closing entries are done, our total debits still equal our total credits. It is the accountant's final seal of approval before we can move on to the next accounting period. This report is doing 4 distinct but totally interconnected jobs for us, and it's really crucial that you get each one. First, it verifies that our fundamental accounting equation, assets equals liabilities plus equity, is still in balance. Second, and this is its unique and most important job, it confirms that all of those temporary accounts now have a 0 balance. This is the proof we need that the net results of all our revenues and expenses for the period, our net income, has been correctly moved into the retained earnings account, which is part of equity. Third, it's our final quality control checkpoint for the period. And fourth, and this is maybe the most critical part for future operations, the ending balances on this report become the opening balances for the next accounting period. This ensures a seamless, accurate transition. Without this step, you'd be starting the new year with bad data, which, as we're about to see, could lead to some absolutely disastrous business decisions. Now, this quote, this is the absolute acid test for understanding this concept. As a student and later as a professional, if you are ever looking at a report that's labeled post-closing trial balance, and you see a temporary account on there, something like sales revenue or rent expense, with a balance that isn't zero, alarms should be going off in your head. You have just spotted a critical and, to be honest, a very amateur error. It means the closing process was done wrong. Specifically, it means the net income from the last period wasn't properly transferred into retained earnings. And that's a huge red flag that could have serious consequences. We're talking a misstated balance sheet, misleading investors, and maybe even getting into some legal trouble. So we've covered the mechanics of the post-closing trial balance. But now I really want you to think critically. Why should you, as a future business leader, care so deeply about what might just seem like some boring procedural check? How does this internal accounting report actually impact high-level strategic decision-making? Let's dig into that. The entire reason we do this is to guarantee integrity at the starting line of the new accounting period. Let's walk through a real-world scenario. Imagine you are the manager of a manufacturing plant, and you're working on your budget for the next quarter. You have to know the exact cash balance the company is starting with to make informed decisions, right? Like, can you buy that new piece of machinery, or can you hire more staff? Well, if the previous period's accounts weren't closed out properly, your starting cash balance could be way off, either too high or too low. And that could lead you to make catastrophic decisions based on flawed data, like ordering a $500,000 piece of equipment you can't actually afford. The post-closing trial balance gives you the confidence that your starting point is solid and completely reliable. This slide here really summarizes the value proposition perfectly. This final check guarantees that the story of last year's performance is locked in and accurate. It guarantees that the new period is starting from a balanced, trustworthy position. This is absolutely critical because the numbers on this report are the exact numbers that are going to be used to create the formal balance sheet, one of the most important financial statements for investors, for creditors, and for you as an internal manager. And most importantly, it enforces what we call the periodicity concept. That's a fundamental accounting principle that just says we can divide economic activities into artificial time periods. It prevents the data from one year from bleeding into and contaminating the data of the next, making sure your analysis is always based on clean, reliable information.
Okay, now let's talk about a very common pitfall that I see students fall into time and time again. It is incredibly tempting to see that debits equal credits on the post-closing trial balance and just breathe a huge sigh of relief thinking everything is perfect. I'm here to tell you that is a dangerous and completely incorrect assumption. Balance does not necessarily equal complete accuracy. Let me explain why, because this is a really crucial distinction that separates a novice from an expert. And this brings us to our final crucial thought for today's lecture. This report is a powerful tool, but it has significant limitations. For example, think about this scenario. A payment was made for a new delivery van. That's a long-term asset, but it was incorrectly recorded as a debit to repair and maintenance expense. Now, that expense account would have been closed out to zero, so the error would be totally hidden from the post-closing trial balance. The company's assets would be understated, its expenses for the prior period would be overstated, yet the trial balance would still balance because a debit was still recorded. Other errors, like a transaction that was just completely forgotten, or a correct amount debited and credited but to the wrong accounts, let's say debiting office supplies instead of inventory, those would also go completely undetected. So I want to leave you with this. While this report confirms mathematical equality, it does not and cannot replace the need for careful analysis, professional skepticism, and sound judgment. It's one critical checkpoint in the accounting cycle, but it is not the entire journey. As future business leaders, it's your responsibility to look beyond just the numbers and understand the real story they are trying to tell.